welcome back to Compliance 101 by Regcompass, your go-to resource for demystifying complex compliance concepts and navigating the ever-evolving regulatory landscapes. Over the past episodes, we have introduced you into customer due diligence processes and educated you on how to build your compliance framework, teaching you about source of wealth documentation and source of funds documentation. Today, we're going to go one layer deeper into building an effective compliance program. And today, we're going to go one layer deeper into one of the most technically dynamic metrics of financial crimes compliance, specifically transaction monitoring, and why rules-based approach are no longer sufficient. So, what really is transaction monitoring? Transaction monitoring is a continuous, systematic approach or process of reviewing customer transactions, payments, inflows and outflows to be able to identify unusual patterns or indicators of money laundering, terrorist financing, and other financial crimes. So, transaction monitoring is a very core obligation for banks, financial institutions, designated non-financial professionals, and every other institution that is involved with the holding and moving of money. Think of transaction monitoring as the operational engine that helps to ensure that you can see what your customer is doing while transacting on your platform. So, you know how customer due diligence tells you everything you need to know about your customer. Transaction monitoring tells you what your customer is doing on your platform. Now, let's look at the rule-based approach. Typically, most organizations in previous years adopt the rule-based approach. And the rule-based approach is built on specific rules that are programmed into a system or are programmed into the platform to flag certain transactions. For example, flag transactions over 5 million naira for individuals, or raise an alert for transactions over 10 million naira for organizations. You could also have a rule that says flag transactions that move in and out of high-risk countries, or transactions that move in and out of sanctioned entities or sanctioned countries. So that's what the rule-based system works like. The advantages of a rule-based system is that it's clear, it's transparent, it's very easy for audit purposes, and it makes it easy for you to be able to identify what rule was triggered that raised an alert. But the downside about a rule-based approach is that while rules are static, financial crimes are not. Criminals can learn rules over time and structure their transactions below the threshold of such rules. For example, flag transactions over 5 million naira for individuals. A criminally minded person can structure its transaction to allow payments just below 5 million naira so that it doesn't raise an alert or it doesn't generate a flag that would then lead to further scrutiny of the customer transaction. A criminal can learn around the rules. So while rules are static, crimes are adaptive. Criminals can adapt to rules. Criminals can learn the rules and structure transactions below the rules. Once a typology becomes widely known such that there is a particular pattern that criminals use to carry out fraudulent transactions, rules are created around such patterns. Afterwards, criminals begin to notice that such rules are triggering scrutiny or such rules are raising alerts into their transactions and then begin to structure their transactions below the rules. Over the years, it has been found out that 90 to 95% of transaction alerts or transaction monitoring flags are usually false positives. False positives are flags that are not actual crimes but look like actual crimes. So because rules are static, when a transaction carries a particular pattern and generates an alert, it is often found out that such rules might not be indicative of a criminal transaction, but maybe a merchant or a customer that is just operating above the rule threshold. How then do we overcome the challenge with a rule-based approach? We now have behavioral monitoring rules or behavioral monitoring systems. And these are systems that are evolving, that learn the behaviors of customers and structure or create rules around individual customers. These are systems that learn the patterns of a particular customer and merchant and adapt the rules to suit that particular customer's transaction type or industry. As opposed to a rule-based system, which is static and the same for every customer, a behavioral monitoring system is configured to each customer. This means that the system learns the patterns of the customer over time, historically, and then generates unique flags or unique triggers for their customer. Let's take, for example, a retail merchant that sells phone accessories would have certain rules that allows it to transact within a particular threshold. But when you have a merchant that does import and export of cement, import and export of building materials, you are probably looking at a higher threshold for that customer. So behavioral monitoring systems learns the transaction patterns based on the customer type, the customer's industry, the customer's level of processing or volumes of processing, and then creates flags that would then be triggered around such customer behavior. So when you see higher transactions between December to January, you understand that this is normal for this customer type. That's it for behavioral monitoring systems. Now, to the highlights of whole monitoring systems, the risk-based controls or the risk-based system. This is an approach that monitors transaction based on the proposed risks or the potential risks that a customer might introduce to your system. Here, you're considering the customer's geography, where they are operating from, you're considering the products and services they are offering, you're considering the intended volumes that the customer intends to transact in. You're also considering customer's industry. So here you have things like a customer or a merchant operating within the cryptocurrency space. There will likely be nuanced or specific rules or flags that will be triggered when you have a customer operating from certain jurisdictions. Let's say a customer operating from the north, you will know that there are certain triggers that also needs to be set. Then when you have a customer that operates in high volumes of transactions, high volumes based on the transactions, you would also have certain rules that will be set based on that customer. So a risk-based approach looks at the customer's geography, the kind of product, and the risks that they're bringing into the system to ascertain the level of scrutiny that will be imposed on such a customer. Juxtaposing the rule-based approach, which is static and applies to every customer or merchant that you are onboarding. The behavioral monitoring system or approach that looks at the behavior of a customer learns it historically to be able to ascertain what are triggers for unusual behavior or unusual patterns. And a risk-based approach, which is the most preferred, of which one, not to say that one should displace the other, they should all work collectively, but a risk-based approach comes up on top because you should always look at every customer from the lens of what risk is this customer introducing into your system, what risk is this customer bringing into your platform. The risk of onboarding a politically exposed person is different from the risk of onboarding a regular individual. The risk of onboarding a cryptocurrency company or platform is different, or merchant is different from the risk of onboarding a retail merchant which trades in buying and selling of phone accessories. To wrap it all up, when building your transaction monitoring system or adopting a transaction monitoring tool, you want to pay specific attention to all of the systems I explained, or all of the logics I explained. The rule-based system, the behavioral monitoring system, as well as the risk-based system. Because there are certain rules that are standard for regulators. For example, the rules around flagging transactions below 5 million naira and 10 million naira is a rule that will always apply. So you don't eliminate certain rules because you feel like you have now adopted a behavioral monitoring system. You can understand the customer's patterns, or you can understand the customer's risk. Certain rules will always apply because the regulator mandates it. For example, a rule around flagging transactions that come into a dormant account. So you would know that whenever you send money into a dormant account, you are not able to pay out that money or pay out those funds until you've gone through certain scrutiny, updated either your proof of address, you've visited the bank or the financial institution to update your KYC details and to explain why the account was dormant and is now being reinitiated, or transactions are now happening again on that account. So those rules would always apply. For behavioral monitoring system, it's also necessary because you want to be able to identify nuanced transactions to your different customer types. And the risk-based approach, which was recently mandated by the FATF as one that must be adopted by all financial institutions or all relevant institutions, is relevant for you to be able to say that based on the rates that is being introduced by this particular customer, certain flags should be raised or certain flags should apply. That brings us to the end of transaction monitoring for today's Compliance 101 video. We've been able to educate you on different rules that would apply, or different triggers or different systems that apply for transaction monitoring. When building your transaction monitoring system or when adopting a transaction monitoring tool, remember that all three of these combinedly help to give you a robust monitoring system. That's it for today. Till we bring you another episode on Compliance 101 by Regcompass, remember to share your thoughts in the comment section, share this video, like, and stay tuned. Thank you.